Welcome to Chapter 1, The Investment Environment of the Investments Text by Bodie, Kane, and Marcus. In this chapter, we're going to talk about several things. The first, we're going to talk about the role of financial assets in the economy, real versus financial assets. Then we're going to move on to the risk-return trade-off and some efficient pricing. And then we'll talk a little bit about the financial crisis in 2008 and the connections between the financial system and the real side of the economy, and some lessons learned for evaluating systemic risk. Let's jump right in with real assets versus financial assets. Real assets, we know what real assets are: land, building, machines, the knowledge used to produce goods and services. They determine the productive capacity and net income of the economy. The more land, buildings, and machines you have, the bigger your economy is going to be, the larger net income is going to be, the more productive you're going to be, the higher standard of living you're going to be, and the less land, buildings, machines, and knowledge to produce goods and services you have, of course, the smaller the economy is going to be. Now, these are real assets. You can touch them, you can see them, you can feel them, they are real. Financial assets are basically paper assets. They're in computers, they're in the ether of the internet, and so on. They are not real assets. So financial assets are claims on real assets. They do not contribute directly to the productive capacity of the economy, but they are nevertheless very, very important. And of course, the examples that everyone is familiar with regard to financial assets are stocks and bonds. Let's talk about some different financial assets just to start with here. Bonds is a term, using the term bonds, also refers to fixed income or debt. In fact, the debt markets, credit markets, fixed income markets, bond market are all the same market. It's just a different way of describing debt, which is essentially a loan. So if somebody says, I bought a bond, what they essentially did was lend somebody money. So a fixed income or debt instrument or asset is a promise for an either fixed income, a fixed stream of income, or a stream of income determined by a specified formula. So a specified formula would be like an adjustable rate mortgage. What you've done is borrowed money and you promise to pay it back, but you know the mortgage could adjust over time. So we still call it fixed income, even though the amount that you're paying back might be slightly different based on some specified formula. So bond market, fixed income market, debt market, credit market, those are all loans, and they're loans to different entities. You loan to the stock, or you can loan to the corporations, you could loan to the federal government, the state government, or other entities. School boards have bond issues, and so on. The next one is very common. We call it common stock, but it's very common in the vernacular to have stocks in your portfolio or own stocks in your 401k or your IRA. And common stocks or equity is ownership of a company. If you own a stock in a company, you're an owner of a company. You have a share in the corporation. Now, obviously, if you own a couple of shares of Apple stock, you do not have a very large portion of the ownership share. You might call yourself an owner, but you don't have a very large stake. So ownership, equity, stock markets are all different terms for the same thing. So we want to think about debt and then equity. And then we have another security that gets a little bit more complicated. And we'll get deeper into this towards the end of the course. And it's called the derivative security. Derivatives are named because the security derives its price off the prices of other assets. So, for example, a very common derivative security is an option, and it's the option to buy or sell some other security. For example, you could have an option to buy Apple stock at a specific price in the future. That's a derivative security because you don't actually own Apple stock, but you have the right to buy it in the future. So you have the Apple stock as a financial asset, but you also have the derivative security that says you have the right to buy it in the future at a given price and time. So derivatives are simply a name for a financial asset that derives its price from another asset. Now, there's other types of investments. For example, you could invest in currency. If you thought the euro versus the dollar, if you thought the euro was going to go up and appreciate in value, you would take your dollars and turn them into euros and watch the euro go up in value, and then you could turn them back into dollars at a lower price and make some money. So you could invest in currencies, and in fact, there are a lot of currency traders out there that do just that. In addition to that, you can invest in real assets through commodity futures. Now, commodity futures is a type of derivative contract because you don't actually have the commodity itself. You have a futures contract or a financial asset of that. So investing in real assets through commodity futures, you could invest in future prices of, say, oil or corn or other real assets. So if you were, say, Southwest Air, and you wanted to make sure that you could get fuel at a particular price in the future, you would invest in commodity futures so you could lock in your price today to take delivery of a commodity in the future. And of course, you don't have to be Southwest Air. You can be just an investor that is making a investment or taking a risk in investing in commodity futures, and with the plans of not taking the oil or the jet fuel itself, but rather selling that financial investment in the future. Now, corporations invest in these futures to hedge their risk, as I said, with oil, but you can hedge risk on all kinds of other investments too, through the derivatives market and through commodities or other futures markets. Now, those are a few overviews of the investment types and real versus financial assets. In our next video, we're going to get into the next segment of this section.